All right, everybody, ladies and gentlemen, good evening and welcome to us here at ATFX. My name is Philip and I will be your presenter for tonight's webinar, Brexit Blues, Market Moods. Everything about the British pound. We will also have a short look at the FTSE as well. Yeah, we want to just see and analyze what the markets are doing. And to be honest, Brexit, yes, it's that headlight event where everybody is lighthouse event where everybody is looking at and is thinking, yeah, we have to have a fundamental stance on this, and this is how we can trade the market. This is how we can have an edge. If we know what Johnson is up, if there will be a no-deal Brexit or not, honestly, guys, we couldn't care less, because ultimately we look at the charts. Everything that is known to the big guys in the market ultimately manifests itself immediately in price, and therefore having an opinion might not be a bad thing to have or to do, but ultimately as a trader, opinions usually hurt us. And our style of trading here, trade with position, is just looking at the charts and seeing what those markets are doing, trying to pick those markets which give us the best opportunity, which look best to us. And then, of course, as always, managing our risk properly and shooting for a large sample set of trades in order to give us those sweet returns that we came here for in the first place. We're already getting the first feedback here that the audio is working properly. Perfect. Thank you very much for that. Let me just quickly change also here the first slide. I hope you can see those slides changing as well. And guys, you already have discovered that small questions box, and please, throughout the course of this webinar, let me know what's on your mind. Do you have a question? Didn't I explain something properly? Should I explain something with a little bit more detail? By all means, let me know. I'm more than happy to answer your questions, or at least try so. Obviously, I know everything that I'm telling you guys tonight, but I want you guys to understand the way I'm looking at those charts. I'm looking at those markets, and therefore, if something is not clear, please, by all means, let me know. You already do see those first risk disclaimers here on the screen. I have to make you aware of those, so please take a moment of your time to read through those carefully and make sure that you're comfortable with them before continuing with the webinar. Essentially, this says that trading, of course, involves risk, and you should understand those risks and the instruments you're using before you are getting active in the market. As neither ATFX nor Trade with Position nor myself are registered investment advisors, nothing that we say should therefore be considered to be actual investment advice. All examples are shown for educational purpose only. Of course, we will be doing this session completely on the live platform, on the MetaTrader 4 platform. I want to tell you guys what I see on those charts, but it's just my analysis. I want to avoid the word opinion, obviously. It's just my analysis, and we have to keep in mind, or we have to be aware that even if we perform our analysis flawlessly, the only thing that we can do is stacking or trying to stack those odds in our favor. But those are just odds, probabilities. And even if we are managing towards a 99% probability that this analysis is correctly, there's still this 1% that the market just doesn't play along. And so for all means, it's just my analysis. Nobody has a crystal ball. I don't have a crystal ball, and I don't know what's coming next. For my personal trading, I'm achieving round about a, let's say, 60% win rate on my trades. And this means out of 10 trades, I will have round about 6 winning trades and 4 losing trades. And this is awesome because this is the way I can make money in the market, managing my risk, staying small with my risk exposure, winning larger on winning trades, and hopefully having more winning trades than losing trades. Trading is not about having only winning trades. The goal of analysis is not only finding winning trades. We want to find the best trades which give us the highest probability, but it will always be just that. It will always just be a probability. So keep that in mind. It's just for educational purpose. I don't have a clue what's coming next. I can just formulate an educated guess based on our analysis. And it's all about the next sample set of 100 trades, 500 trades. The next 20 trades absolutely mean nothing at all. That being said, please make sure you're okay with that before continuing with the webinar. And here we are with our agenda. We check in on how the British pound is rallying amongst the major currency pairs. Is it rallying, or is it rather weak at the moment? How is the pending 31st of October Brexit deadline impacting on the Forex market? Are there potential trading opportunities? And as I've said in the beginning, it's great to have an opinion. It's good to think this through. Think if if a Brexit is rather good for the United Kingdom or rather bad. And everybody has their opinion, and yeah, just leave it. Let's leave it at that. Everybody has their opinion. I feel that if we are moving towards a Brexit without any deal, without any regulation, there will be a lot of complexity in the details, which nobody is thinking of right now. And once this hits, the people down there in the trenches, at customs, at the travel office, at you name it, those will suddenly have a lot of questions because a lot of things won't be regulated. Suddenly there's a void. And I'm not really sure that this is a good situation to have. And apart from that, my major concern from a safety perspective is for Northern Ireland, of course. And I still remember from my childhood days, the news here in German television that there was again a clash, civil war-like situations in Northern Ireland. And I was really at ease and felt it was a good thing that ultimately the peace process started there. And even though there might not still be this good everybody loves everybody and is their neighbor spirit there, it's a peaceful situation at the moment, and I'm really afraid that this situation might be going away. But that's just me. That's just my take on Brexit, and of course everybody has the right to determine for themselves what they want to do and how they want to lead their lives. And therefore, that being said, let's talk about the markets here. And as I said in the beginning, I have this idea, and I was able to observe this idea not so long ago in the past, that every information that you have and that is available out there is pretty much immediately reflected in price action. So we don't have to have that Bloomberg feed. We don't have to have that news feed where we don't have to have that fast internet connection for Twitter and waiting and seeing what's going on there and who's tweeting what and what could this mean. No, I can see this almost immediately within price. And my proof of concept for this, everything is already there in price, was the US presidential election. I was staying up late and was watching that and was watching the markets. Next, on one screen there was the TV, other screens had the markets on it, and I was able to see who took the lead, for example, in Florida, just by looking at the S&P 500 futures. It was obvious that at that moment Hillary Clinton was in the lead. And just a few seconds later, price drop, markets went crazy, and I knew, okay, now it was Mr. Trump. And on CNN or on Twitter, the news feed there, about 2-3 minutes later, I got this information there. Yes, I was right. Now Hillary took the lead. Now Donald was the leader. Twitter was fastest. About 5 minutes later on, 10 minutes, CNN, they had the news. And of course, great German television, around about half an hour later. But price was there within a second. Price showed me first who was in the lead. And so I feel it's just the same thing here with Brexit and with anything else. What the market thinks might happen is reflected here within price action. And so it's perfectly fine to just focus on price action. Don't get me wrong, news is important, especially around scheduled news events. We just have to go back a few days. For example, the S&P 500, the Fed meeting in the United States, where they decided to cut the rate, but not cut the rate so much and not ongoing, but rather a single event, as they said. Nobody believes them, by the way. But that was their stance, and this was a scheduled meeting. Everybody knew that this meeting was coming, and sure enough, everybody also expected that rate drop, or that announcement of the rate drop. but the reading between the lines was a little bit off, and therefore the market reacted and was happy to sell the market off. And this was a scheduled news event. Everybody was aware that the Fed meeting would be there at that point in time. And our take on those scheduled news events is you want to be out of the market when those news events are about to hit the wire. Why? Because usually you will get a great move, a great volatility expansion, and this swing will usually go both ways. Currently, we also do have earnings seasons in the United States, and I do have a few stock positions on there, and I make sure that either I have a big enough buffer on those on my profits on those stocks before I close the position there, or before the earnings are announced, because always the earnings swing will go both ways independently of which direction ultimately wins. Even if the market is going higher afterwards, there will always be this shakeout to the bottom, volatility expansion. I usually do not want to have a position like that unless I already have a decent profit and can handle that volatility at that point in time. Be out of the market around those scheduled news events. Unscheduled news events, like the great tweet from Mr. Trump just a day later, yeah, who knows? Who knows? But once again, I was watching the markets and I just saw, okay, price is going down. What great things have happened. And my buddy just sent me a message. Come on, there must have been a tweet or something. And then we had a look, and obviously he was tweeting again, and China and everything. But price showed it first. So once again, let's just focus on price here. We want to look at several of those currency pairs involving the British pound here, and let's just make this a little bit larger here. All right, so let's kick it off with the euro against the British pound, and we're starting our analysis here on the daily chart. Why the daily chart? Because I feel I want to have a base image. I want to have a foundation where what I think that this market is doing. Is it a strong market? Is it a weak market? Do we have a trending environment? Yes or no? And that information, if the market is trending, that's the information depending for the time or related to the time frame that we're looking at. It's not that euro British pound is in an uptrend on all time frames. No, it's currently in an uptrend here on the daily chart. If we have a look at the monthly chart, we see technically not sure if this is an uptrend. I can see that this market pretty much has been moving sideways for quite some time. I see currently or recently we've seen lower lows, but now we're about to make higher highs here. So is the picture really clear what's going on here on the monthly chart? No, it isn't. What about the weekly chart? Yes, the weekly chart is in an uptrending environment, and I don't have to have any fancy indicators to understand what the market is doing. I just really look at price action. And what I can see here is that price has been making continuously new higher highs and higher lows all along the way. A little bit deep pullback here, but then after that, just a new higher high, pulling back to form a new higher low and continuing higher to a new higher high. Simple as that. I know that euro British pound is in an uptrend here on the daily chart, and the daily chart does set the stage for me. That's the foundation, that's the basic idea I see. All right, the weekly chart is showing strength, the daily chart is in an uptrend and is showing strength. And therefore, what kind of trading opportunities might I be looking for here looking at euro British pound? I might be looking for long trading opportunities. Why? Because my trading strategies are trend following strategies. This means I'm looking for a trending environment and I try to find good opportunities to join that existing trend. I feel that it's easier for me as a trader to just jump into a river and let the current of this river carry me with it, instead of trying to swim upstream all the time, paddling like crazy, not really going and getting anywhere. Rather jump in, swim a little bit, but rather let the main work be done by the current. And that's the same thing, at least in my eyes, with trend following. I want to look for a good opportunity to join this trend. I'm looking for a good deal. I don't want to buy an uptrend at any price. Neither do you want to sell a downtrend at any price. And as an example for this, let's have a look at the S&P 500 here, and let's just have a look here at the hourly chart. And sure enough, this was a beautiful downtrend, but would I want to sell this market here? Let's make this a little bit larger. Do I want to sell this market here? No, because we are overextended. This market has moved too far, too fast. This is not a good deal. I feel that if I sold this market here, I'm selling too cheaply, and that I have that risk of price snapping back. And this is exactly what happened afterwards. Price pulled back to price equilibrium levels, as we like to call them. And therefore, I'm looking for a good selling point, a good selling opportunity here in this downtrend. And a tool to look for those buying and selling opportunities are our moving averages. You can see here in this S&P 500 market example that we're looking at a 10, 20, 50, 200 period moving average, and they have a specific pattern that they're showing us. And this pattern is they are all separated from each other. They are not crossing each other, just like we saw here, or just as we saw there. No, they have a clear structure. There is little noise in the structure of those moving averages. I only get that kind of structure if I am in a trending environment. And yes, it's a trending environment, but we are overextended here. Overextended with regard to what? To our moving averages. Because we can see that one aspect of price action that pretty much everybody in the market is agreeing upon is that price is mean reverting. And this is just a fancy way of saying price will either pull back to its moving averages, or price will wait a time for those moving averages to catch up. But ultimately, price can never be away from its moving averages for too long. Ultimately, they will meet again. And they will meet again here. Price is by a good means away from those moving averages. And this is what we like to call overextended. I would want to sell this market if I'm overextended. I know that there's a decent probability for price to pull back, and once price has pulled back, then I'm looking for an opportunity to sell this market. Because every time, think of this overextension stuff like a rubber band, an elastic band. You just pull this band, and here it's stretched. And now suddenly you let it go with one hand, and it's just snapping back on your other hand and giving you a little bit of pain. And this is exactly what would happen if you sold this market here. You do not want to sell this market when this band is extended, it's snapping back and it's painful. Selling this market when it's overextended, there's risk of price snapping back, moving against us, painful. We don't want to see that. We don't want to have that. And guys, I know today's about the British pound, but it's the same thing across all different markets. That's the nice thing. Once you understand technical analysis, it's not about a specific market. It's not about a specific time frame. Everything that I'm telling you here, the same type of analysis would be just the same if I looked at a commodity, at stocks, at indices, at treasury products, at you name it. It doesn't matter, because I'm analyzing price action, and price action is just the visible result of people acting in the markets. So ultimately, I'm not analyzing some obscure numbers, but rather I'm just like Plato's cave. You don't see the people acting themselves in the market, but you just see the shadows. You just see the prices that they produce on the trades that they do in the market. And therefore, analyzing those shadows, analyzing those prices is absolutely a viable approach to trading. It's not trying to read your tea leaves. You try to understand what people had been doing in the past, because then you might have an idea how the majority of people might be behaving in the future. And this is again where the probabilities come from. It's never 100%, but rather stacking the odds in our favor. So S&P 500 moved to the downside, overextended. I don't want to sell this market. Coming back to our British pound here, pushing higher. Do I want to buy the market at that stage? not as terrible as the S&P 500 was, but again, we're overextended. But now we're pulling back. Where do we pull back to? We pull back towards our moving average buy zone. Pullback could have been a little bit deeper, but honestly, I don't know where this line is coming from. Let's just zoom out a little bit and start to see that the market has been reacting to this line a few times in the past. Another very powerful analysis technique are those, I like to call them simple, stupid horizontal lines of support and resistance, because everybody usually is thinking, well, indicators have to involve complex mathematics, they have to be fancy, borderline to rocket science, and can't be that a simple line like that actually has some merit for trading. But guess what? It has. And the reason is also quite simple, because ultimately people reacted to this price level. At that point, people were buying this market, but suddenly the buying stopped and sellers became way more eager to sell this market again. And this happened one time, this happened a few more times, and every time price approached this level again, people remembered and looked at their charts and said, wait a minute, when price approached this level back in the day, selling started. So they became reluctant to buy this market. And again, and now finally price is pushing towards this level. And you see here, price react to this level, came close, short overshoot, coming back. I would have expected to see a little bit more test going on here, but ultimately we broke. Now, the nice thing is that those lines stay on your chart. And it's not that if this line is broken, it's suddenly invalid. No, because support turns into resistance and resistance turns into support. And a very common pattern that you see is once this is broken and we pull back, where do we pull back to? We start to test this level once again here from the upside. Why is that the case? This now truly has to be some kind of magic, doesn't it? What's going on there? Very simple. Price approached this level here. And as we saw in the past, when people started to sell this market at that point in time, usually that was a good trade back in the day. They could make some profit there. But now something has changed. Price started to push higher. So everybody who sold the market short here at this level now suddenly had a losing position on their hand. And the losses were getting larger and larger and larger. And at that point, they probably were in quite some heat. They took some heat and said, okay, I want to get out. What's the battle cry of the losing trader? I will get out once or if I break even. And guess what? Where those guys break even? Those shorts, which are still holding the back at that point. They are holding the back precisely at this level. And this means that once price comes back towards this level and is at this level, those guys have now the great opportunity to cover their short positions for a pretty much very small loss, if at all, and they're out. So this short covering going on at that stage is what creates another wave of buying, of course, buying pressure coming into the market. And then coming back to test this level, buying pressure setting in, and price continues higher again. So this is a pattern which you can not rely on, but which you can, on which you can bet, on which you can use efficiently when it comes to your trading. Going for the level, waiting for the level to break. First thing is trying to trade the breakout of this level, one of our strategies. And the other strategy is seeing if we get a pullback to price equilibrium levels, and if we can make use of that level here as well. That's just the icing on the cake. Use those simple, stupid lines, horizontal lines of support and resistance, not sloping trend lines, horizontal lines, because they will always have the same value. They are absolutely independent of how you draw them, which points do you connect. Sloping trend lines, everybody and their dog suggests that you use sloping trend lines. All right, we use a sloping trend line from there to there. That was a valid sloping trend line at that point in time. Guess what? That sloping trend line had been broken. Was this actionable in any way, shape, or form? I don't see it. Now you will tell me, no, that's the wrong way to draw it. You have to draw it, of course, obviously, with that point in time. We always have to trade the right side of the chart. So this all here is not known. That's the latest swing point low. So now something has to happen. No, nothing happens. Line is broken, nothing happens. Price just keeps on going sideways. And all right, no problem. We can fix this. We can just redraw this trend line. And so we draw the trend line from here to there. It's not really that actionable. And guys, if I'm drawing this only slightly wrong, if I'm off by a pixel or two, just a few more bars out there, that difference with proper drawing precision really adds up. Next thing is, it's not easily actionable. Even if it was actionable, not easily actionable, because guess what? The value of that line changes with every single bar. Sure enough, it's sloping. And I would have to adjust my orders for every single bar. Doesn't make any sense for me at all. Predictability or usability is not that high. It's rather subjective for how to draw it properly. And the next thing is not really that actionable because all the order management can become quite complex. Let's put it that way. On the other hand, I know this line is here. I know this line is at this price level and it will stay at that price level. How was I able to draw this line? I just looked at a region where price touched or where price turned around and reacted to a certain price. And this happened 2 times, 3 times, more times. The more, the better, the more significant that trend line, that horizontal line suddenly becomes. But just 2 touches of the same price is enough to form this line. And you see, once you've identified it, it stays in your chart and the market keeps on reacting to those lines over and over and over again. So what do we know about Euro British Pound? It's an uptrend, uptrending market. I have once again our fanning structure here in our moving averages. We're looking here at the 10, 20, 50, and 200 period moving average. We can see that price is pushing higher. We can see the horizontal level of support resistance holding true here. And yeah, that's pretty much it here for this market. Let's have a look at the lower time frames. 4-hour chart, and you see the same structure going on here. You can see the price is pushing higher. What do we have here? We have an uptrend pulling back. Where do we pull back to? Moving average buy zone. Not the perfect pullback, moving sideways, pushing higher, and new higher high, pulling back, lower, higher low here as well. We are still in an uptrend, and this pullback here could have been a potential buying opportunity. Why? It's a red candle. It doesn't matter that that candle is red, because ultimately what we want to see here is the structure of this candle. And we want to see that price is giving us the idea that it wants to go higher. How can we see that here? If you think about it, it's always try to tell a story. You look at that chart and you want to try to tell a story. And the story here is price opened at this level, and obviously there was a lot of selling pressure. How do I know that? Because price traded all this way down here to our 20 period moving average, all this way down. But this is not where the story stopped, where the story ended. Ultimately, there was more buying pressure coming into the market. How do I know? Well, price started to push higher again. Price started to rally. And here at that stage, we were able to reverse all of this price action. We were able to close that trade or close the session pretty much where we started. Small upper shadow, but the long lower shadow. This is what makes this a more bullish type of candle in my book. It's not a perfect bullish candle, could have been way better, but the structure overall, the shape of this candle is what started to suggest to me that the market might be turning around, that there might be more buying pressure coming into the market. And guys, every time somebody tells you that there have been more buyers than sellers, that's completely nonsense, because obviously for every buyer, there has to be a seller. The only thing that differs here is the type of pressure that they wanted, how urgent they want to do the deal. If the buyer thinks this market is moving higher faster, he wants to buy, and he wants to buy. He's not trying to be penny wise and dollar foolish. He wants to buy this market, and if it's necessary to hit the ask, he's going for the ask. And this is what creates the higher prices. Buyers not waiting for sellers to sell at their price, but rather starting to accept the ask price that sellers have been asking. Buying pressure coming into the market. Trades going off at the ask and no longer at the bid. This is what creates upwards price movement, not more buyers than sellers. It's just how urgent they want to do the deal. So 4-hour trend upwards. What's the 1-hour move here? 1 hour also, and you start to see that same pattern all over again. 1-hour chart, upwards move, uptrend, higher highs, higher lows, fanning pattern in those moving averages, moving higher, reverting to its moving average. Small candles near the buy zone and pushing higher. And again, here, next buying opportunity. Did this work out? No, it didn't. Once again, trading is not about having only winning trades. Trading is about having hopefully more winning trades than losing trades, and you want to win bigger on the winners than you have to pay for on the losers. Perfect example. Was it a perfect setup? No, because the moving averages already had started to pull back here. Would this have been tradable? I think so, but yeah, then again, not much harm done. How could this have been traded? Well, my entry would have been above the high of this green candle. I want to see that price is starting to push higher again. I want to see the price is, why is this my trigger candle? Because obviously it's a bullish candle. And I want to see that price is pushing higher and giving me my entry. So I'm going in 1, 2 ticks, pips, points, whatever you want to trade. Again, it's the same thing across all different types of instruments and markets. So that's my entry. Where would be my stop loss? My stop loss would be sitting below the swing point low, which is the low of this red candle here. So I'm putting my stop loss right there. Why there? Because I think I've identified the new higher low. And therefore, price should now continue to push higher. And if that assumption is wrong, then I want to be out, because this is not obviously not the new higher low, or the trend is changing or anything else. But obviously my most basic assumption, I've identified the turning point in this uptrend, is no longer valid. And this is why I want to be out once price breaks below this low here. Does this make sense, guys? Does the entry make sense? Does the stop loss location make sense? Any specific questions here, guys, or any general questions? Please, by all means, I'm running this session for you, so don't be shy. Just let me know what's on your mind there. And here in this example, would we have been triggered into that trade? Could be, maybe, I don't know, but obviously didn't work out. So even if we would have been triggered in here, we would have been stopped out there. I would have risked 1% of my account on that trade, which means I would have lost 1% of my account. 10,000 pound account, 100 pounds would be gone now. Is this nice? Absolutely not. Is this devastating? Is this something to go crazy over? Absolutely not. No problem at all. Rinse and repeat, because I know out of 10 trades, I should be able to win 6 of those trades. And here I lost 100 pounds, but if things would have worked out, a 1-to-1 risk-reward ratio probably would have seen my profit target round about this area. And if I had gone for a 2-to-1 reward to risk ratio, that could have been somewhere here in this area. So if I win my trades, I win something between 1.5 and 2 times the risk that I take on those losing trades. And this is how we make money. We win more than we lose, and we hopefully win more often than we will lose. And for that reason, having 4 losing trades out of 10, even having 5 losing trades out of 10, is no problem at all, because those winners are larger, because we properly define our risk exposure up front, because we properly manage our position going into that trade, and I know all this stuff up front. This is not that I'm sitting there and hoping and praying and thinking, oh my God, now I'm in that position, what do I do? Where do I want to close that position? The usual thing that our mind tells us to do is, I'm up now already 30 pounds, let's close that, everybody knows, nobody has ever gone broke taking a profit, right? Ultimately, this is what will kill us in the market, because the losing trades will lose us 100 pounds, 1% of my account. If I just realize a gain of 30 pounds, that's a reward to risk ratio of just 0.3. This is horrible. This is really bad. I want to know all this stuff up front. I must know where I want to enter precisely. I want to precisely know where I exit if things don't work out. I want to know where I want to exit if things are going my way. Winning more often than we lose, and winning bigger. Two critical, crucial components here. All right, basic, same analysis technique. Now, the trend has changed here. We're moving now from let's get rid of those lines here at the moment. We're moving here from a high to a low. We have a lower high, we have a lower low, lower high, lower low. And now we're just starting to push higher again. We start to see the moving averages had flipped over. How do I trade this here and now? I don't. I'm looking for beautiful setups. I look for clear structures, just like here. I look for something where I know, yeah, I have an edge. All things come together. All those analysis techniques stack on top of each other and give me an edge. Here I don't have an edge. Here I just know that this downtrend probably is over. The market might be moving higher up again, which might be in line with what the 4-hour chart is telling me, which might be in line with what the daily chart is telling me, but I'm not really having a proper setup here. I'm not having something great where I say, yeah, that's it. I want to enter that position here right now. But overall, British pound, rather weak here. The euro is getting dearer. Price is going higher. And one thing to be aware of, there's still a lot of time left, but usually once we approach big magic numbers like 1.0, US dollar, Japanese yen, 100 points, 1.0 in Swiss franc, US dollar, Canadian dollar, big round numbers, 10,000 points in the Dow Jones, 10,000 points in the German DAX. People pay attention to those numbers. Same thing when the S&P recently just made 3,000 points. Yes, this was in mainstream media. What is a big round number? Usually the more zeros there are in this number, the more interesting that number suddenly becomes, and more people will pay attention to it. Again, how does this play a role for us? Well, simple. If people think, oh, 3,000 points in the S&P 500 is too much, what will they do? They will think there might be an opportunity to short this market at that point. So they will have their orders waiting there. Those people who are long going into this type of market might think, there might be some resistance around 3,000 points. So why not sneak in a sell order to take some profits at 2,999.5? Again, selling pressure. We have the shorts waiting there with the orders. We have the profit takers waiting there with the orders. And this is why suddenly price will react to 3,000. Has 3,000 any magical properties? Absolutely not. Nothing at all. It's just that people think, people act, and people react to those numbers. The more zeros, the bigger the number, the more likely it is that people will have their orders there and waiting. So overall, uptrend here in euro against the British pound. Let's have a look at cable. And this time, British pound is in the first position. And if we see that everything is falling here in this market, it's just the same picture, but now from the other perspective, once again, the British pound is weak. Here, the euro was getting dearer because it was in the first place, and British pound was weak because it was in second place. Here, just flipped the other way around. But same story here. British pound is rather weak at the time being. Same analysis. How do I know it's a downtrend? Obviously, lower lows. Let's make it larger again. Lower lows along the way and lower highs. And guys, here, those are the typical setups that we want to see. We want to see that price is pulling back here. Where should it be pulling back to? Moving average sell zone. Small bearish candle setting up in the sell zone, and we go lower. And the next potential setup there. Things like that over and over again. Rinse and repeat. Trading shouldn't be exciting. Trading shouldn't be about the latest, greatest indicator and thing. Trading should be about making money. And simple and robust makes money, or I prefer making money that way than yeah, black box trading with some kind of neural networks, which also can be interesting. But here for my manual trading, I'm looking exactly for things like that. Rinse and repeat. So weak market environment here again for the British pound. We have been overextended. Would this have been a good point to short the market? No, we're waiting now for price to pull back. And guys, by the way, one way where we have now an idea where price might be pulling back to, because we know where our moving average sell zone is, the 10 and 20 period moving average here. But we also could be using our fib retracements. We take our fib retracement from the most recent swing point high to the current swing point low and let it go. And now we have here our fib retracements. Always draw those fib retracements in a trending environment. They just don't work in a range bound environment because, yeah, fibs are a trend related tool. Fibs are a hammer, and you must have a hammer, aka nail problem, if you want to use a hammer. And that's just the same thing here. You want to have a trending environment before you use those fib retracements. Recent swing point low, L high to the recent swing point low, fib retracements of the first degree. And here we're looking at the 38.2, but mainly 50 and 61.8. So if I have to make an educated guess where a perfect harmonic pullback might take us to, I would expect this pullback to go towards the 123, 230 range, something like that roundabout. 50% to 61.8% retracement is the sweet spot. This happens to also be still here in our moving average sell zone. So another idea that a pullback might be going there. And we could now trade this multiple ways. The usual way for me to do it would be to say, all right, I know price should be pulling back towards this area here. And once I'm sitting there, I'm waiting for a small bearish candle setting up here. And this is my trigger candle. This is how I then would like to trade this market to the downside. If you were more aggressive, you could say, all right, I want to find further ideas why this might be a sweet spot here. And then I could already put in my sell limit order here around the 50% level, waiting for this pullback to occur. And once price is there, I'm already triggered into my trade. Different ways to trade this market based on different basic assumptions and aggressiveness factors and settings. And by the way, one thing that you also could do is we now have drawn the fib retracements from this swing point high to this swing point low. But we could, of course, do it also from the next significant swing point up here. And I screwed it up. You just click once and you go to the same swing point low here. And now that would be the second degree fib retracement. And what I'm looking for here is some kind of clustering action. For example, here we can see that the 38.2 and the 23.6% retracement levels, they are very, very close to each other. Both of those are not really awesome fib retracement levels. So yes, I take note that this might be a sweet spot for a pullback, but I'm not really that interested. Too shallow of a pullback, both on first and second degree retracements. But on the other hand, for 38.2% retracement, second degree, sits right in the middle of the 50 and 61.8% first degree fib retracement. And this is rather interesting for me. If it was sitting perfectly on top of the 50, I would have appreciated that way more, but currently the way that it is works for me. So once again, another indication that this area here might be a potential sweet spot for a pullback. You can stack those analysis techniques on top of each other. You could also be using pivot points, for example, and you can use those pivot points as daily pivot points, but also as weekly pivot points, monthly pivot points. Maybe break it down to hourly pivot points if you want to trade 5 or 15-minute charts. You want to see multiple reasons to take a trade. You want to see multiple things pointing towards the same location, that same potential trading opportunity. It's just like an inspector of Scotland Yard coming to a crime scene. He wants that everybody is telling him the same story. Because if everybody is describing what they have seen and it's the same description of the same suspect, he has a decent idea what might be going on. But if everybody is telling him a different story, and if they couldn't even agree if it was a man or a woman who committed the crime, he's pretty clueless. And that would be us as traders. If I'm clueless, if I don't have a story, a consistent story that the market is telling me, and that the market is telling me the story from different angles, different time frames, different analysis techniques, different technical tools and indicators to use. If I'm not getting that same consistent story there, I'm not that interested in that market in the first place. So keep that in mind. Some tools easily can be used like that. For example, here, those fib retracements. And what is this market doing here on the daily chart? It's going down. The 4-hour chart, yes, we're moving sideways now. This was observable here in this extended move to the downside. Now just moving sideways here to hit and to meet the moving averages again. Let's have a look at British pound against the Japanese yen. We're looking at a monthly chart. What can we see? Well, the monthly chart, we have been here in this range pretty much since forever. But now just more momentum has been picking up. Those moving averages are starting to fan again. 10, 20, 50, 200. We're looking here at the daily chart, and oh boy, on the daily chart, sure enough, and guys, it's just picture book perfect. Pulling back, where do we pull back to? Moving average sell zone. What do we get? A small bearish candle and continuation. And small bearish candle, trend continuation. Small candle, indecisive candle, followed by a bearish candle and trend continuation. Find a pattern like that. Find something that is just... Does it work all the time? Once again, absolutely not. But if you find something like that, if you find and are able to identify the environment, what price is doing is suitable and is working, and you're able to identify the same technical analysis factors over and over and over again, this is how you trade. You are not looking at a chart and saying, what could I do today? No, what is there? What is the market currently giving me? And all those pairs with involving the British pound so far show us that same theme. Yes, the British pound is getting weaker. And can we trade it? Absolutely. We have now seen 3 pairs. All those pairs on different time frames gave us opportunities. What is it that I would expect to see here now on lower time frames? Well, what are we? We are a wee bit overextended. Not terribly, but we are overextended. We're seeing a bullish candle currently forming. So I would expect to see that a potential pullback move is going on. Where might this pullback move take us to? Well, it might take us here into the moving average sell zone. Let's have a look at the fib retracements. Guess what? The sell zone is currently perfectly in the sweet spot of 50 to 61.8% retracement. Another idea that we might be moving there. Let's go one swing point higher and draw it in again. And this is what I meant. You see the 38.2% retracement of the second degree move now perfectly sits on top of the 50, and the 50 second degree sits perfectly on top of the 61.8. Once again, adding so much more probability that either one of those two spots or price levels might be hit. I have to zoom out now. I have to use my stupid horizontal lines of support and resistance to further enhance that story and see if something is going on. But I could be looking for potential pullback here. I said I could be looking for potential pullback. I do not want to trade this pullback on the daily chart. I wait for this pullback to happen and then trade in the original direction of the trend, which is to the downside. That being said, that move to the upside here, it makes sense on a daily chart. But if we start to drop down now, 4-hour chart, 1-hour chart, 30-minute chart, 15-minute chart, you start to see the price is starting to push higher. And if this move happens and manifests itself, sure enough, it has to manifest itself as an uptrend on those lower time frames. And this is where a potential long trading opportunity could make sense. If the daily chart is in a downtrend, I don't want to trade short on the 4-hour chart. Hourly chart, probably also not. But if I find a nice trading opportunity here, potentially as a long trade on the 15-minute chart, this could make a lot of sense. Why? Because my entry would be based, and by the way, it's not here, it's just something that makes sense to wait for and to look for. Why could this be a great trade? Well, I could make my entry here based on the 15-minute chart, which means that my entry and my stop loss are coming from the 15-minute chart, from the candle sizes of that 15-minute chart. But I know where a potential profit target might be. A potential profit target might be sitting here at 132.15. And now suddenly, at least for a part of my position, I have a risk, a position size based on a small candle entry on a 15-minute chart. And I have this huge move all the way to the upside to hit my potential profit target here on the daily chart. And this is how you suddenly arrive at reward to risk ratios of maybe 5-to-1, 7-to-1, 10-to-1, maybe 20-to-1, I don't know. You want to have those potential huge winners in your account. Always manage risk, always be consistent. But if you have the opportunity to make an educated guess where this trade might be taking you, then by all means, if you get a tight entry, small risk, and can swing for the fences here, go for it. Again, not a trade recommendation, talking about general ideas and principles. By the way, the 15-minute chart isn't giving me an entry here right now, but you can see that currently 0.2 points roundabout would be the size of one of those candles here. And we're swinging here for shooting for a trade, which would be roundabout three points away. Huge reward to risk ratio potential on those type of trades and setups there. Let's have a look at the British pound Swiss franc. Again, monthly chart, range bound, and now just starting to drift down, continuing this overall move to the downside here. Moving averages starting to fan again on the monthly chart. The weekly chart, obviously, much more pronounced action to the downside. You start to see the moving averages fanning. The daily chart, beautiful downtrend here, and bearish candle in the sell zone, bearish candle in the sell zone, bearish, small bearish candle in the sell zone. Rinse and repeat over and over again. Once again, British pound rather weak. British pound against the Australian dollar. Here, technically, we might be speaking about an uptrend, but the moving averages are all over the place. It doesn't make any sense for me to get rather interested or thrilled about this type of chart or market environment. The daily chart, yes, it's a downtrend, but again, compare it with what we've seen now just against the yen, against the US dollar, against the euro. deep pullbacks here, pretty much 100% pullback, only slightly new lower low. And by the way, guys, that this is just a slightly new lower low. This is what creates this clear cut. We have a low here and we have a lower low there. So obviously a lower low. Healthy downtrend, is it? No, it isn't, because the pullback was deep here and took some time. And if you don't realize that this was a rather deep pullback and rather slow, an easy way to spot this is by scanning for divergence, which means you drop down here to our MACD indicator. At that point in time, MACD was here, and once we made the new lower low in price, MACD actually was sitting there. And this line is going down, this line is going up, divergence. At this point in time, RSI was trading there. At the next lower low in price, RSI also made a new higher low. Divergence. Our indicators do not show us the same thing that our price action is showing us. That's an early warning sign that this move might be coming to an end. And sure enough, this pullback now, a lower low being followed by a higher high, this is no longer a downtrend. Why would you want to trade this market here, British pound against the Aussie, on that time frame here, if you can have a clear downtrend like that, if you can have a clear uptrend like that, if this is what you could be trading here against the Japanese yen? Yes, the British pound is weak, but pick those markets which give you the best edge, which give you the best setup. And don't trade all of those markets, pick the best, or maybe pick the best two. But if you pick the best two, don't risk 1% on each of those trades, because then that risk would be correlated. You would be stacking that risk. You don't want to do that. Risk 0.5% of your account on each of those two trades then. British pound against the Kiwi dollar, it's just the same thing here. Pretty much the same as the Aussie. Lower low in price, divergence, clear cut here in MACD and RSI, new higher high there as well. Not interested at all. British pound against the Canadian dollar. Guys, can it get any more beautiful than that, what we're seeing here? That trend has been going on since May, since the beginning of May. Beautiful move to the downside. Consistent, slowly, boring, tight entry, awfully small candle here. Why is a small candle so awesome here? The candle is awesome because, let's zoom in. We might be going a little bit over time, but this is just such a beautiful example. Where's my entry? My entry would be below the low of this red candle here. I think this market might be turning, indecisive candle. This is where my entry would be. Where is my stop loss? My stop loss would be above the swing point high, which would be the high of this green candle here. So this might be my stop loss location. And now you can see how tight that entry is. That's my stop loss, that's my entry. And so shooting for a 1-to-1 stop reward to risk ratio would be roundabout here. So price has to travel only a very small distance to give me my first profit target. 2-to-1 reward to risk ratio would be somewhere around here. So already the first candle triggered me into that trade. Second candle gave me my first profit target and my second profit target. And thanks to that small candle, there would also have been a decent probability to hit a third profit target down here. Small candles are crucial for our trading strategy because they allow us to give us tight entries, which allow us ultimately to shoot for large reward to risk ratios on our trades. Compare this with an entry of, let's say we wanted to trade based off that green candle here. Doesn't make any sense at all, but just for the sake of it. Much greater distance. And now to give me a 1-to-1 reward to risk ratio, price would have to travel by quite a bit. Compare it to that tight entry that we had here. Tight entry, small candles, easier to hit our profit targets here. Let's close it with the UK 100, with the FTSE. Obviously, that market was slowly grinding higher without much ambition or joy. And then when the tweets from Washington started to come, obviously everything started to fall apart. This is pretty much in line and in sync with what we've seen here with the S&P 500. Oh, the rally has been canceled, everything is over. I don't think so, because if you look at it, this was a deep pullback. Where did this pullback take us to? Well, way beyond our moving average buy or sell zone. And a healthy pullback, by the way, should be something around the 61.8% retracement levels. And this pullback here took us way beyond the 61.8% retracement. So very deep pullback, a lot of momentum being lost. And what we see here now, in my eyes, is just a technical reaction, a technical pullback. And I think this pullback might take us to 2,902 to 2,900, let's say 30, roundabout in this area here. How do I know? Why do I think that this might be a sensible area? Well, because here I have my FIB pullbacks, my FIB retracements, and probably we can identify some levels there as well. Guys, time's pretty much up, so let's quickly jump back here to our slides and wrap this presentation up. Why should you consider ATFX as your broker? You want to have a good and solid business partner. You want to be able to focus just on the markets and not worry about technicalities, not about having a sound business partner, worry about the way that they conduct business. Will my money still be there tomorrow? The way to do it is to go for a broker which is completely regulated, for example here, by the British FCA, Financial Conduct Authority. You do see the registration number, clear as a segregation of funds, difficult word to say, and easy way both to fund your account and to withdraw money from your account, because ultimately you want to spend those profits that you make. ATFX is committed to providing competitive prices for their clients. You have seen the MetaTrader 4 platform in action. And if at any point something is not clear, be sure that there's somebody that you can talk to, that they who can help you with your technical questions. If you haven't done so, please consider opening a live account today. You see the contact details here of ATFX, the phone numbers to ring them up, email addresses to be in touch with them, and of course, if you want to pay them a visit, their street address is there on the slide as well. So guys, if you don't have any further questions, then I would wrap this session up. Thank you very much for tuning in. I hope you enjoyed today's session. You learned something new, something useful was there, something new, a different angle on how to analyze those markets. Any feedback that you have for us is really appreciated. There should be a survey coming up after the session, so please don't be shy. Let us know what you think about this session and how we can improve. And now to all of you, a very nice evening. Happy trading over those next few days. And Brexit, yes or no, keep a happy smile. Guys, all the best. Thanks again and bye-bye.